Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to be using. Well, the S&P 500 and the NASDAQ continue to set new all-time highs, and it's not just the big tech stocks leading the way. We'll talk about that, but is the rise in the markets justified by the earnings reports? We'll delve into that and more troubling reports about the housing market. It's coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fregasso Advisors. Thanks again for joining us for The Bull, the Bear, and You. Now, this, of course, is the day that most businesses close their books on their second quarter earnings. We have to wait roughly 2 weeks before those earnings start to come in, being reported. And before we know just how well the companies have done for the second quarter. But we do know now how well the stock market has done in the last 30 or 60 or 90 days. The markets hit a low on April the 8th after the Trump administration announcement of higher tariffs and sweeping tariffs. Now, since the close on that day, the markets have stair-stepped higher, with the NASDAQ gaining nearly 33% from the low of that day. The S&P 500 added nearly 24% from that April low. And those gains have led to new all-time closing highs for both the NASDAQ and the S&P 500. But, according to a report in Bloomberg over the weekend, some big-time money managers are growing concerned about the markets. The tariff deadline is approaching, the conflict in the Middle East, and the war in Ukraine, all of which add to what some say is rising economic uncertainty. So, is this a case of the old phrase, the market's just climbing a wall of worry? Kim, why don't you take it first?
Sure. Well, I think the best thing about the end of the quarter is the rise over just in the near future, is the beginning of earnings season. And we're going to get a lot of information, not just what happened in this past quarter, which, the meltdown, we'll call it a meltdown, that happened in April, and that was quickly resolved, at least in investors' minds so far. We're going to see what companies are really seeing with respect to tariffs, with respect to all of the turmoil of, how the Trump administration handles disputes and arguments, both the economic kind and the military kind. And now we really want to know what companies are seeing from their customers about demand for their products in the future. That is what I get out of earnings season. And I have to tell you, I think the average investor has been leading us higher for a lot of reasons. And I think everybody else has a great different perspective than I do. But I'm going to say, the AI trade has always been in question this year. Is it dead or not? And right now the answer is no. The AI trade lives on. So that has been one of the leading, but not the most leading industry that has led us up the proverbial wall of worry. And we get, with every company that comes out and reports AI demand, it still is strong. Not crazy strong, but strong.
That being said, go ahead, Carrie.
I was just going to say, it's interesting because there's always a wall of worry, right? Like I've been in this industry now for next year will be 40 years. And I'm sure that my fellow panelists here can say the same thing. There's always a wall of worry. And there's never a time where there's not something to worry about. And, there are always reasons to sell. Very rarely are there reasons to buy when you really think about it. So, I think that the thing about it is that you have to really look at what we're worried about as an investor. What are you worrying about, and what implications does that have to your portfolio? If you look at the situation in the Middle East, it's there, it's a risk, but what is really the risk? And part of the risk is what happens to oil prices. Well, you can then go to your portfolio and say, I don't really want to carry this risk. So let me make the appropriate changes to kind of steer away from that risk. Back when the financial crisis happened in 2008, we kind of saw the writing on the wall, to be honest with you. When you really looked at the quality of bank earnings and how the whole banking system and shadow banking system was working, we had taken the initiative to really reduce our exposure to financials. Now, I'm not going to sit here and say we knew exactly what was going to happen and to the degree it happened. I mean, if we knew the degree to which it would have happened, we would have went to cash, but you don't have that. And back at that point, there was actually a book written called The $1 Trillion Meltdown, and then they published another edition of it shortly into that cycle, and it was called The $3 Trillion Meltdown. So, it really, when we look at the worries, it doesn't mean, as an investor, you get out. You just have to really play out those scenarios and make the appropriate adjustments.
All that being said, it comes back to what Kim always tells you. It's about the earnings of these corporations and what we have happening, I think, in the market. Because I think individuals are participating more than they have in recent times, we're seeing stocks get in play, if you will, because of events, whether it be AI or some game show or the gambling craze that's going on, or defense stocks because of the wars, and these things get moved around, and the people are moving money like checkers on a checkerboard because of the headlines. And my caution to everyone who does that sort of thing is go back to basics, figure out the sustainability of the business that you want to invest in, and see if their earnings are priced at a price that you can remotely make sense to, and then make the investment. Or, as the trend in the industry is, turn it over to a manager and let them do that. Like Kim.
I think that. I think from a geopolitical standpoint, Stacy, what you asked before, I don't think the markets really care all that much anymore about so many geopolitical events. Not like they did, decades ago, for sure. I really thought when the U.S. Took out some of their nuclear capabilities, the market would have a more of a reaction than it did, and it just didn't. So, I mean, from a humanitarian standpoint, I think we all can agree that everything that goes on in the Middle East is pretty terrible, disastrous, whatever you want to say. But from a market standpoint, even oil, I mean, Kerry pointed out, like, that's probably the biggest risk, but that hasn't moved to the degree that I thought it would at all. So taking that out of it, I don't think the markets, quote unquote, care as much longer term about many geopolitical events. From the markets climbing the wall of worry, I don't know what's going to happen this year. My highest conviction thesis is this isn't really going on a limb at all. I just think returns going forward over the next 5, 6, 7, 8, 9 years is going to be significantly lower than what we saw over the past decade. That's kind of what I've been telling clients. So sort of start preparing for that, just given the fact that your starting point from a valuation standpoint is so much higher today, even than it was after the all-time highs we hit probably 8 years ago or so. So Kim does bring up a good point, though. If AI can make stocks cheaper, meaning your earnings really grow into that multiple, that's your best bull case there. But I'm not necessarily counting on that. I think that's a hope. I think I'm hopeful for that. But again, I think you need to be positioned, or have your psyche needs to be set for the potential for returns to be lower going forward than they were the past decade.
I don't know. I hear what you're saying, Michael, but I don't know. Maybe Kim's kind of swayed me over to her way of thinking that that technology, right? But I think that AI is going to have a much bigger impact than we might think, and it's a double-edged sword. I'll give you an example. We were looking, just at our microcosm here, and really what our capacity needs are, and we were getting ready to hire someone. we hadn't identified the person, just starting the process of hiring. Well, at the same time, our broker-dealer approved an AI transcribing software package that we can now implement. Obviously, it's not a recording. They don't record it. It's just transcribing. So instead of my team having to spend hours, and when I say hours, I mean hours, writing notes, transcribing notes, we are now implementing this software, and we now don't need to hire a person. That's like in my little world. Now, the flip side to it is there's a person out there that was going to get a job that isn't getting a job, right? So I think that as with any new industry or technology, what you then have to start to consider is, well, what are the other jobs that will exist in the future because of AI that we didn't have before? You know, you're probably going to have AI specialists and AI implementers and AI consultants. So I think it's something to be aware of. AI is coming at us in our industry faster than we can even keep up. So it's going to be a really interesting and exciting time. But to Michael's point, you know, you do have to really question the influences and can these companies grow into their multiples, because when you're growing into a multiple, that means the multiple isn't necessarily expanding as fast as it was, which leads to the point of will returns be as great as they are in the next 10 years as they were in the past 10.
Yeah, the only thing I definitely couldn't agree more. We use that same AI software too, Carrie, here. Yeah. So I mean, I definitely see it impacting all of our industries. I think the only question you have to ask is how much of those expectations are already discounted in the valuation multiple, right? We're already 4 or 5 turns higher from a median standpoint from valuations than the median. So if it doesn't come to fruition, you know, your returns over the next 5, 6, 7 years are just going to be a little bit lower than going forward. But to be determined, to be seen, I guess, on what happens. I'm very hopeful that we can grow into them, though.
If you look if you look into history,
Go ahead.
Go ahead.
we're in a transformational time. We had one with the Industrial Revolution. We had done one with the onset of radio and TV. We had another one on the onset of computers in general. We had another one on the onset of the internet, and now we have another one with the onset of AI. People are saying this is going to be the biggest of all of them, and maybe it is. That remains to be seen. We've managed to come out with it with more employed people working. The biggest problem I think we have right now is we don't have enough people to do work. So maybe this will actually do away with the problem of we aren't making enough babies. So that our employment force is on a trend to shrinking, and this is a worldwide thing, not just the United States. Nobody knows about Africa and Latin America, but aside from those 2 continents, the rest of the world seems to be in a population funk, and this may be the answer to that problem. And I hope it is. It's going to be exciting, as Carrie says.
And Michael, let me try to sway you over to my side. It's fun over here, by the way. So I think everybody, I just want to hammer this home. In the last probably 15 years, the technology that has driven the market and has driven the market higher and at higher multiples has been what I consider anti-productive technology. Google, or not Google, Meta, you know, I mean, Netflix, this is stuff that you're wasting time. You're not doing anything productive. And I think even stuff like, I love the example, and I'm going to totally use this when I talk to clients, Carrie, about the transposing. Is
Transcriber, yeah.
Yeah. That software, you're right, it just takes a ton of time and makes a better product than even, trying to figure out what did I talk to this client about and what do I need, and if you can just get it all down, that's even better. But so we're going to be able to have greater productivity in areas that right now we don't even know. I'm going to say this kind of crazy, I want a humanoid robot to make my bed and wash my floors. That's interesting, but that's not going to be the headline news 15 years from now. I don't know what it would be. I'm looking for that like super jump in productivity. But whenever we first see a technology, we get the output completely wrong, but the direction right. So I think productivity will be huge throughout the world with technology.
I don't know if you guys are going to like this or dislike this, but the particular platform on which we record this program uses AI, and after you're done talking, it will give me a synopsis of everything that you've said. So, and it's accurate. It's there. I want to move on. Go ahead.
One more point.
Yeah.
So I love that Frank brought up these other periods of time where you've had technologies, whether it's the Industrial Revolution, the internet, and when you do look at those time frames, there are periods of time where the exuberance takes over. So, to Michael's point, even though Kim has swayed me, like that's one foot on her camp, because you still have to pay attention. All these great, exciting things. You can look at the railroads back in the early 1900s and how, just look at what the price of U.S. steel did over the turn of the century and how it was basically an internet or an AI stock during that time, and it crashed, and it took 10 years to gain its value back. So definitely a word of caution.
I don't know. Does the Monopoly board still have the 4 railroads on there?
It does.
Okay.
I'm sure that will change to like Netflix Meta.
Yeah, maybe it's going to. I don't know. I do want to move on here for a second. And, in the Wall Street Journal, columnist James McIntosh notes that with the rebound in the markets, at this moment, big tech is not necessarily driving the market. He notes that some other unloved stocks, and he cites Dollar General, they're the ones that are driving the market. Michael, I'll go to you. Are we seeing more of a broad-based market now than we had before? In other words, the what is it, Magnificent Seven or whatever they're called, leading it?
Yeah, I don't know if it's that answer is very binary, like I said, yes or no, Stacy. To be honest with you, when you look at like the Magnificent Seven, stocks, Kim's favorite Meta is up 25% this year, but Apple's down 20%. Amazon's somewhat flat, and Nvidia's up over 20% or so. So some are doing well, some are not. What I do think though is the big are still getting bigger to the detriment of the small cap stocks. So we finally got to a point now where the S&P 500 is the most concentrated it has ever been. There's something called the Herfindahl Index, where it's only 55 stocks in the S&P 500 are driving pretty much all of the returns, and that's the most concentrated it's ever been. So from that standpoint, the big are just simply continuing to get bigger. Are you seeing a slight broadening out to like outside of tech with the Dollar Generals? Yes, but if you look at the equal weighted index, where every single stock is weighted the exact same, the S&P 500 is still outperforming that year to date. I think the bigger problem, I think, is really on the small cap side of things, Stacy, where those are, I think they're still negative on the year. They're having a really, really hard time breaking out because the economy is still strong, but it's not super strong to drive the cyclical component of the market, which are the small cap stocks. So from an investment standpoint, we still like, the larger stocks and the mid cap stocks more than the small cap, but nevertheless, some of the Magnificent Seven are not really holding their own in this environment.
Yeah, I think that the article, like pointing out Dollar General, we have seen a little bit of a broadening out, as Michael said. The cap weighted index is up maybe at like 1% more than the equal weight, meaning when you kind of normalize all stocks, but. I think the reason that we have seen this kind of leaning more into what we would call value stocks like Dollar General, is just that fear of recession. That this year there's been a lot more concern about the impact of tariffs, fear of a recession. And when that happens, it's very normal that investors would be looking more towards those kind of more blue chip stocks, maybe stocks that pay dividends to get some reward. So it's not unusual the place to be has been international, and we've talked about that in past recordings. So having a diversified portfolio makes a lot of sense.
All right, I'm going to tie. Go ahead, Frank. I didn't mean to
No,
interrupt.
go ahead, Stace.
I was just going to try to tie the first two segments we talked about here and ask this question, and that is that since I've heard time and time again how important the earnings reports are to figure out whether a stock is one that you want to own or not own going forward. So with this rise in the markets that we've seen, is it justified by the previous earnings reports that we've seen?
Apparently it is. No, well, what you really look at to say, are things getting better or are they getting worse, is what is happening to company guidance. Now, companies have to, by law, tell you what they think, what they truly think is going to happen in the future. But they can always, and they always choose to, well, most wise companies choose to set the bar relatively low in the world of possibilities. What we have not seen, and we are in something that I like to call pre-earnings or earnings alerts season. If a company knows it's not going to be able to make its guidance that it gave in the prior quarter, it has to come out as soon as it knows that. And we have had no pre-announcements that I can see that have been meaningful. So it's pre-announcement season. And that would give you an indication that the economy or the prospects for a single company are worse than they anticipated. And they don't want to get sued, so they are on it whenever they know that they're not going to make their quarter. Today's the end of the quarter is when we're taping this. So at the next couple of days are tenuous because they'll see what they were able to sell this quarter. And those kind of indications tell you, are things getting worse, is when companies come out. So all things being equal, investors look at what the companies have said they can earn for this quarter. They haven't updated anything, and people kind of hold their nose and go, yeah, they probably can make this quarter. So it is worth owning this company because they're going to put up the growth, or they're going to put up the numbers that we think they are at a minimum.
I think the earnings growth, Kim, correct me if I'm wrong, to start the year have been pretty solid. They've been pretty good, but I think analyst expectations are for earnings to come down in the back half of the year. And there are a lot of uncertainties.
Oh, there.
Yeah, I know. I think one of the things we haven't talked about this program we talked about in the past is the tariff, this 90-day deadline is coming up in like a little over a week, and really what's going to happen there could be a precursor to what happens regarding earnings over the back half of the year. If everything kind of ratchets back up to our quote unquote reciprocal tax number, whatever we're calling it, that could be pretty detrimental to a lot of U.S. Company earnings. But I think a lot's going to remain to be seen over the next week or so, as Kim pointed out.
The NBA's playing right now, and you probably ought to look at economic news and political news the same way you watch a basketball game. Teams have runs. Doesn't matter which team you're on, they'll have a run, and it says we're going to have tariffs, and the other side will have a run, like Canada, who backed off a tariff, which means they're going to talk again. It's going to be back and forth, up and down. It's going to make the market look sleepy compared to the way the news moves things back and forth, which is probably, to your point, Mike, that the market's ignoring all this stuff, and the reason is it changes by the minute.
Yeah, it changes by the minute, and there's a lot going on. I mean, when you look at the tax bill that's trying to get through right now, there's some, optimism on that end of it from an investor's point of view. So, there are a lot of different things that really can impact earnings. But, we do know that the market is always looking out 6 to 9 months. So looking at earnings and are they reflective of the last quarter is not how this is approached. It's approached to, okay, the market's going up, so it's anticipating that things over the next 6 to 9 months should hang in there. And the market can get ahead of itself. I mean, we have corrections, and it's unusual to not. We've had one earlier this year. I think for anyone that is interested to know what we had to say in early April, those videos are out there. And fortunately, things have really kind of played out the way that we've been discussing. So I think we do have to wait and see. Michael brings up a great point about the tariffs and, knowing what you own and how your stocks, not just how your stocks will perform, but probably more importantly, what your time frame is and what your risk tolerance is, because we will have, there's not much I can say like that we emphatically, but we will have more volatility going forward.
All right, one final question for you, and that is, we're not talking about the Fed much anymore. Is it going to have any impact at all? I mean, let's just say that the unemployment numbers come out this week, I think on Thursday, because the 4th is a holiday, and I guess their next meeting that they could act then would be in July. And let's just say that they make some sort of a surprise announcement on cutting rates. Is it going to? Will it have an impact on the markets?
Well, I'll jump in here and say I think it will have an impact on the markets. I think, given that for the most part, other than this last bit of data we got on Friday, it looks like inflation seems to be either flat or trending down over certainly the longer haul if you look further out. But there is one sticky situation that we have, that an area of an industry that isn't working is housing. It's just not, it's sort of kind of working, but not for the people that we want it to work for most, which is first-time home buyers. And that the interest rates that the Fed sets really do make a difference for first-time home buyers that have no equity in a home, and they have to, they're putting down cash. So I think the Fed is going to be predisposed to lower at some rate to give housing some kind of a break. And that, my friends, will drive the market even higher, because whatever the 10-year is at is what the industry pros discount earnings back with. And a lower multiple to a lower interest rate gives us a higher multiple that we're comfortable with. So this is a self-fulfilling prophecy that if the Fed cuts rates, it's likely to lead to a market that goes higher.
Right. I don't think anybody anticipates the Fed cutting rates in July. Maybe, they're talking about one, maybe two rate cuts in the fall, if that. But you bring up the housing market. We were going to discuss that. I didn't know if we had enough time, but I'll go ahead and throw it out there since you brought it up. And that is, of course, that home sales were up 0.8%, still near historic lows. New home sales dropped 13.7% in May. Home prices rose at the slowest annual pace in 2 years. And this one bothers me. More homeowners find themselves underwater and owe more on their mortgages than their homes are worth. But it seems, just like the interest rate things with the Fed, nobody's paying much attention to this, or am I wrong on that?
Well,
I'm sure the Fed's
one really important fact to know is that housing has about a 7. Yeah.
Go ahead.
The Fed has about a 7, or not the Fed, the housing market has about a 7 times multiple when it comes to economic activity. So you buy a house, you go to Home Depot every night for 30 days, and then you're ordering from Amazon for everything else, right? So we know it's a very important driver to the economy. Until we really start to see that implication, I think the Fed is going to just kind of wait on the sidelines, because we do know how this works, but I think at this particular time, the data just isn't there for them to lower. And Stacey, you hit on, and you guys know this, one of my biggest pet peeves is when people say, well, they're anticipating that they're going to lower. They don't know. I love when commentators come out and say, well, that we're anticipating they're going to lower 3 times by the end of the year. And we all lived together through they're going to lower 7 times next year. And that really didn't happen. So, we've got to take the data as it comes, and we have to that will lead to whether or not the Fed lowers or not. But housing is a big driver. It's probably one of the primary things to watch, housing and unemployment.
Michael, you want to wrap it up for us? We've lost Frank for some reason. I don't know why.
I mean, I can wrap it up by saying I don't have much to add to Carrie and Kim's comments right there. I think they nailed it right on the head with the housing market.
Okay, good. All right, well, thank you. We'll continue our look at investing in the economy in future editions. And since you're watching or listening to this particular program, I ask that you hit the like or the subscribe button on whatever platform you happen to be using. So thank you again for joining us, and we'll see you again in about 2 weeks or so for the next edition of The Bull, the Bear, and You.